Good day, I'm Lovely for Mary Maandig, and today we will discuss Chapter 17, Band Fundamentals. So first, I'll be introducing the basic features of band characteristics, rates of return on bands, the global band market structure, participating issuers, participating investors, and band ratings. So what is band? So when we say band, imagine maglend kag money to a company or government for a set period. A bond is essentially that loan. So public bonds are long-term debt securities where you as an investor nga galend og money to the issuer, which is the company or government. So they promise to pay you a fixed return or interest payments and you pay the original amount you lent. So, kibali mo na siya ang principal at a future date, which is the maturity. Key features. So, first is interest payments. So, imagine getting a regular paycheck gikan sa company or government. That's the fixed interest you will receive periodically, usually semi-annually. So, this is your income from owning the band. Next is principal repayment. So, this is the return of your initial investment. So, at the end of the loan term or maturity date, makuha ni mo imong money balik plus the interest earned. Maturity categories. So, first is short term. So, think of this as a very short term loans like maglend kag money to a friend. So, this mature in a year or less and they are often called money market instrument. And they are generally less risky but mag-offer sila lower returns. So next is intermediate term. So these are like lending money to small business for a few years. So they mature in more than a year but less than 10 years. And they typically offer a balance of risk and return. So next is long term. So these are like lending money to a large corporation or government for a decade or more. So these bonds often have a higher risk potential, but the potential return could also be higher. Bonds have unique characteristics that impact their value and risk. So first is coupon. So this is the interest rate the bond pays. Think of it as the interest rate or coupon in the bond. So the higher the coupon, the more pud imong ma-receive nga income. So next is maturity. In maturity na term bonds. So one is specific date for repayment. Imagine a single payment at the end of a loan. And next is serial bonds. So, multiple repayment dates. Imagine paying off portions of the loan over time. So, next is principal value. So, mauni siya ang original amount you lend, not the market value. So, this value stays the same until the bond matures. Next is ownership type. So in bearer bonds, the bond's ownership isn't recorded, so making it easy to sell without official paperwork. Like a gift card, you just need to show the bond to get your coupon payments. Next is registered bonds. So ownership is recorded. The interest is paid directly to the owner on record. There are different types of bonds based on security and features. First is secured bonds. It's like a mortgage bond backed by a specific asset. So if the issuer defaults, the lender has a claim on the collateral. Next is unsecured bonds. So the issuer's creditworthiness is the only guarantee. So these are like trusting the company's promises. Next is subordinated debentures. So these bonds have a lower claim on the issuer's assets than other debts. So they often used in municipal finance like a junior partner. Next is refunding issues. So using bond proceeds to pay off existing bonds like refinancing a loan. Indenture provision. So this legal document outlining the terms of the bond, much like a contract for a mortgage. So it includes details on repayment and the trustee to ensure the issuer is following the agreed upon condition. Features affecting maturity. First is callable bonds. So, the issuer can repay the bond before the maturity date, offering options for the issuer and investor. Next is freely callable. So, this issuer can call the bond at any time. And non-callable, the issuer cannot call the bond until the maturity date. And next is deferred call. The bond cannot be called until a specific time in the future. And the last is sinking funds. So, a fund set aside to systematically repay a portion of the bond over time. So this is like setting aside money for a house payment every month. So this can affect the overall maturity date as portions are repaid. So there are 5 categories of participating issuers. So first is sovereign bonds. So these are loans made to national governments. For example, when you buy a US Treasury bond, you are lending money to the US government. And next is quasi and foreign governments. So this includes bonds from certain government agency like Fannie Mae and bonds from other countries' governments. Next is securitized and collateralized bonds. So these bonds are backed by a bunch of assets. So like home loans or business loans. So if the borrowers don't pay, the bondholders can claim those assets. Next is directly issued corporate bonds. So these are loans given directly to companies. So when you buy these bonds, you are lending money to a company instead of the government. So next is high yield and emerging market bonds. So these include riskier bonds from companies that might not have great credit ratings and also bonds from developing countries that may have less stable economies. So who invests in the bond market? So both individuals and large institutions take part in buying bonds. In individual investors, they make up a small part of the market because bonds can be complicated and usually require a lot of money to invest. While institutional investors, these are bigger players and they conduct most of the trading, about 90 to 95% of it. So they are more organized and experienced. There are types of institutional investors and what they focus on. So first is life insurance company. So they mainly buy corporate bonds and sometimes government bonds. And next is commercial banks. So kani siya nga banks ga-invest in municipal bonds like local government bonds and government securities. Next is property and liability insurance companies. So they mostly focus on municipal bonds and government bonds. And next is private and government pension funds. They invest in a lot in corporate bonds but also in government bonds. And next is fixed income mutual funds. So these funds invest in a wide range of bonds to create diverse portfolios and have grown a lot in popularity. So factors that influence what institutional investors prefer. First is tax rules. So different tax regulations can make some types of bonds more appealing to certain institutions. And commercial banks, they like short to medium term municipal bonds because those are often tax-free. And next is pension funds. So since they don't pay taxes, they generally prepare long-term government or corporate bonds, which offer higher returns. And next is nature of liabilities. So their investment choices depend sa ilang financial responsibilities. For example, pension funds with long-term obligations favor long-term bonds. So, impact of their preference. So first is supply and demand. So the preference of institutional investors can influence kung how much money is available for loans in the market and the interest rates. Their choices can also lead to changes in the interest rates. So bond ratings provide a critical measure of the credit worthiness of different issuers, including corporate and municipal bonds. While most of these bonds are rated, it's worth noting that smaller issuers in certain industries, particularly banks, may not always receive ratings. The three primary agencies that we rely on for bond ratings are Fitch Investor Service, Moody's, and Standard & Poor's. So each of these agencies plays a significant role in assessing credit risk. And while their methodologies might differ, the ultimate goal is to evaluate the risk associated with bond issuers. So this consistency help investors trust the ratings provided. Bond ratings assess how likely it is that a bond issuer will default on their obligations. So a higher rating indicates low risk, reassuring investors that their investment is safer. So understanding this risk factor is crucial for making sound investment. And there are key factors in credit analysis. So when rating bonds, agencies consider several key factors which include the financial health of the issuer and their historical performance and future forecasts. Essentially, these factors help agencies determine if the issuer can consistently meet its debt obligations. As investors, recognizing these factors can guide our investment choices. Bond ratings assess how likely it is that a bond issuer will default on their obligations. So a higher rating indicates low risk, reassuring investors that their investment is safer. So understanding this risk factor is crucial for making sound investment. And there are key factors in credit analysis. So when rating bonds, agencies consider several key factors which include the financial health of the issuer and their historical performance and future forecasts. Essentially, these factors help agencies determine if the issuer can consistently meet its debt obligations. As investors, recognizing these factors can guide our investment choices. So, impact of ratings. So, bond ratings don't just reflect risk, so they significantly influence marketability and the interest rates attached to bonds. So, higher ratings generally lead to lower interest rates, which benefits the borrowers. Interestingly, there are something split ratings, where different agencies may disagree on a bond's quality, creating confusion for investors. And the rating scale. So understanding the rating scale is crucial. So ratings range from AAA, which represents the highest quality, to D, indicating default. So bonds rated as investment grade AAA to BBB are seen as lower risk, while anything rated BB and below is considered speculative. So this distinction impacts the risk return profile for investors.
Good day everyone. Today we're diving into chapter 17.3 of Investments and Portfolio Management, where we'll explore alternative bond issues. We'll go through 5 key categories: domestic government bonds, government agency issues, municipal bonds, corporate bonds, and international bonds. And we'll also break down 5 important exhibits that illustrate key concepts in the bond market. So let's begin. Let's start with domestic government bonds, primarily those issues by the US Treasury. These are treasury bills, treasury notes, and treasury bonds. So treasury bills or T-bills are short-term securities with maturities of 1 year or less. Treasury notes mature between 1 and 10 years. Treasury bonds have the longest maturity, often up to 30 years. These securities are backed by the full faith and credit of the US government, which makes them virtually risk-free in terms of default. Now, take a look at Exhibit 17.4. It illustrates how a treasury security pays semi-annual interest over its life and return the entire principal at maturity. So for example, if you buy a $1,000 10-year treasury note with a 6% coupon rate, you receive $30 every 6 months and then $1,000 back at the end of 10 years. This predictability makes them attractive to conservative investors. Next, we have government agency issues. This includes bonds issued by the federal agencies and government-sponsored enterprises, commonly known as GSEs. Examples include Ginnie Mae, which is fully backed by the US government, Fannie Mae and Freddie Mac, which are GSEs that issue mortgage-backed securities. Let's now examine Exhibit 17.5. It compares government agencies like GNMA, which carry an explicit government guarantee, and GSA like Fannie Mae, which have an implied guarantee, meaning they are not technically backed but are still viewed as low risk due to federal ties. These agency bonds typically offer higher yields than treasuries, though with slightly more risk, especially for GSAs. Now let's talk about municipal bonds or munis. These are issued by state and local governments. There are two main types of municipal bonds. So first is general obligation bonds or GO bonds, backed by the issuer's taxing power. The second one is revenue bonds, supported by the income from specific projects like toll bridges or water system. A major advantage of municipal bonds is their tax-exempt status. Interest income is usually exempt from federal income tax and often state tax too if you live in the issuing state. To compare a muni with a taxable bond, we use the equivalent taxable yield or ATY. So the formula is ATY is equals to I over 1 minus T. So where I is the municipal bond yield and T is your marginal tax rate. Let's move to corporate bonds, which are issued by corporation to fund business operations or expansions. Corporate bonds vary widely by credit rating, coupon structure, maturity, and added features like convertibility, call options, or sinking funds. Now, let's talk about credit risk. Some corporate bonds are investment grade, meaning they are considered safe. Other are high yield or junk bonds, which offer higher returns to compensate for increased default risk. So, in Exhibit 17.3 explains the bond ratings. So, investments grade bonds are rated AAA to BBB. These are considered reliable and stable. Below BBB, such as BB, B, and CCC, are considered speculative or high yield. Understanding these ratings helps investors manage risk and return expectations. So in Exhibit 17.6 shows the volume of new high-yield bond issues over time. As you can see, issuance tends to rise during periods of low interest rates and strong investors' demand. For instance, during economic booms or low-rate environments, companies are more likely to use junk bonds. These periods often align with increased investors' risk appetite, making it easier for lower-rated companies to borrow capital. So in Exhibit 17.7 provides a snapshot of the composition of high yields indices based on credit quality. It shows relative proportions of BB, and CCC rated bonds. This breakdowns is crucial for portfolio managers to assess the risk level of high yields bonds. For instance, a fund heavily weighted in CCC bonds would carry higher default risk than one focused on BBB rated debt. Last but not least, we have the international bonds. These give investors access to global fixed income markets, helping with diversification and currency exposure. So international bonds came from in different forms. So first is foreign bonds. So foreign bonds issued in the country by a foreign entity in the country's currency. Example, a Japanese company issuing bonds in the US is a Yankee bond. So next is Euro bonds, issued in a currency native to the issuer or market. For example, a US company issuing bonds in Europe in US dollars. Other example include samurai bands issued in Japan, bulldoze bands UK, and matador bands in Spain. These instruments offer high yields but also currency risk and political risk depending on a country of origin.
Good day everyone, I'm Ramil Fernandez and I will discuss the crucial changes in how bonds investor access prices information, particular since 2024. Historical context. Historical na sila significant difference in the accessibility sa prices information for bond. Investor compared sa ilang stock counterparts. While stock investor have always had real-time access to transaction prices from major exchanges like NYS, AMEX, and DAS. And bonds investor face a more challenges environment. Action trace. This changed dramatically in 2024 in introducing for the trade reporting and compliance engine or trace by the National Association of Security and also known as a NESD. Trace began realistic for time pricing data for cooperative bonds, which was a game changer for the market. Expansion of reporting. Trace enhancement started with reporting on 4,500 cooperative bonds with 25 minutes by the end of 2004. This expanded to 7,000 bonds reported with just 30 minutes by 2005. This reporting include and also 23,000 cooperative bonds issued. Impact of bond market. The impact of these changes has been profound. The increased prices, 10% in cooperative bonds market has led to significant transaction cost savings. Investor can have more informed decision based on time pricing data. Risk of electronic trading. In the National of Trace, the rise of electronic trading platforms such as Tanso Trade with a market access has the further improved the efficiency and transparency of the cooperative bonds. Intelligent and electronic trade has limited the government agents as the mortgage-backed security bonds by late 2004 cooperative bonds trading against sanction. Future prospect. Looking ahead, experts believe that the electronic trade might extend into high-yield bonds, market debt, and interest rate derivatives which will likely continue this trend to increase transparency and efficiency in bond market. Next, I will discuss how to interpret bonds goals, especially focusing on cooperative bonds, treasury and agents bonds, and municipal bonds. Understanding these goals is crucial for making informed investment decisions in the bond market. And bonds are essential instruments in finance that enable governments and corporations to raise capital. Interpreting bonds goals allow the investor to assess a bond's value, rate, and associate risk. The characteristic of their primary types of bonds goals are cooperative, treasury and agents, and municipal bonds. Cooperative bonds. When we talk about corporate bonds, we are examine several key components. Price usual as a percentage for par value. For example, a bond with 102 is selling for 102%. For each 1,000 par value, meaning its price is 1,020. Yield. This indicate the return of investment for the bond holders and is crucial for comparing different bonds. Coupon rates. The interest rate is the pay to the bondholders, and maturity date, the date when the bonds will mature, and the user must repay to bonds face value. We have treasury and agents bonds. Treasury bonds, kani siya nga bonds is gina-issue siya by the federal government and are the often considered free due to the government banking. The cost for treasury bonds are often reflect their yield after the price. For example, if a 10 years treasury bonds show a yield for 3%, it means investors can expect of a return of 3% per year based on the current market price. Agents bonds. These are the issue by government entities like a Fannie Mae, Freddie Mac, while they are also generally considered safe. They carry slight for risk than treasury bonds because they are not backed by the government in the same way. The understanding of this cost is vital for investors looking for heights agents volatility in the financial market, as treasury bonds are especially seen as a safe. Municipal bonds. Di ba last kay ginidiscuss na itong municipal bonds? Municipal bonds are issued by state of local governments to financial public project. 1K advantage of this bond is ang interest earned is especially experienced from federal income tax and tax in the same case state of local tax as well. Like corporate bonds, municipal bonds are often as the percentage for par value. For instance, of the bonds has a 98. It means of the trading of 98% of is 1,000 face value of 9,800. In conclusion, chapter 17 has shown us the basic part nga kailangan na tumahaybalan about the bonds. Understanding things like interest rate, how long a bonds, and if the borrower is likely to pay back the money is the key to figure out a bond's value and how risky it might be. Bonds can give you income and even make you money if their price goes up, but it's important to know about sa possible nga downside, like kung ang interest rate change or if the borrower nga dili mabayaran. The global market is the always change. The getting these simple ideas down, like talk about in the chapter, is the most important first step for anyone nga gusto mag-invest in or understanding bonds. This basic knowledge will really help us we learn more complicated way to handle bonds later on.